Okay, good evening. Let's continue. The interruption was very long because of the brownout. So anyway, let's just continue in problem 21-1. The requirements are to compute for the basic earnings per share. So we divided the net income to ordinary share by the number of ordinary shares outstanding. So we have 33.35. In requirement number 2, we have to determine the diluted earnings per share. So first, we have to determine the diluted shares. Initially, we have 100,000 ordinary shares, and then the bonds payable, if converted, will result to 30,000 shares, since the conversion ratio is 20 ordinary shares for every 1,000 bonds. And so we have 1.5 million bonds payable. Divide this by 1,000. We have 1,500 and we multiply by 20. So we get the bonds payable shares converted resulted to 30,000 ordinary shares. So we have now the total, and the total number of shares diluted is 130,000. Divide 3,440,000 by 130,000. We have the earnings per share, diluted earnings per share of 26.46. Then for the preference shares, assuming that this will be converted, or the preference share capital of 3 million, and stated this is convertible into ordinary share in the ratio of 2 ordinary shares for 1 preference share. And since you have 30,000 preference shares, 2:1, so the number of shares of ordinary shares after the conversion of the preference shares would be 60,000. So the diluted earnings per share after the conversion is now for 190,000 shares, and the net income of 3.8 million, giving the earnings per share equal to 20. So the incremental EPS on bonds payable is 105,000 divided by 30,000. That gives 3.50. So 3.50 for the incremental EPS on preferred stock. We have to divide 360,000 by 60, leading to 6 pesos. So both the bonds payable and the preferred shares, or the preference shares, are potentially dilutive because the incremental EPS is lower than the basic earnings per share. Now, based on the rules that I have read earlier. So the bonds payable, we have the incremental EPS on the bonds payable is 3.50, and the incremental EPS on the preference share is 6, and both are lower than the basic EPS. Basic EPS of 33.33. So these two securities are potentially dilutive. Next, we go to 21-2. In 21-2, the requirements are basic earnings per share and diluted earnings per share. At year-end, Gay's company had 100,000 ordinary shares and 20,000 convertible preference shares outstanding, in addition to 10% convertible bonds payable in the face amount of 2 million. During the current year, the entity paid dividends of 5 per share on the preference share. The preference share is convertible into 40,000 ordinary shares. The 9% bonds payable are convertible into 30,000 ordinary shares. So the net income for the current year was 2,140,000 and the income tax rate is 30%. So for the basic earnings per share, we have the net income of 2,410,000, and then we have the preference dividend of 4 the preference shares. We have 20,000 preference shares, and we have the dividend at 5 pesos per share. So that gives 100,000. 2,410,000 minus the preference dividend, the net income to ordinary share is the balance. Now, for the basic EPS, we have 2,310,000 divided by the ordinary shares outstanding of 100,000 shares. Now, for 23.10 is the basic EPS. Next, we have to determine the diluted earnings per share. So the basic EPS, let's now begin with the net income, the shares of 100,000 with basic earnings per share of 23.10. Then the diluted earnings per share for the preference shares, we have 100,000 shares, and our net income 100,000, and then we have 40,000 shares. So the preference shares net income of 100,000. So the preference or during the current year, the entity paid dividends of 5 per share on the preference shares, and we have now the preference shares is convertible into 40,000 ordinary shares. Now take note that the preference shares, we are given the 20,000 convertible preference shares outstanding, and the preference shares convertible into 40,000 ordinary shares. So we now get the ordinary shares of of preference shares. Initially, we have 20,000 convertible preference shares, and the dividends paid was 5. So we now get the total diluted earnings per share of 2,410,000, and the shares, ordinary shares increased by 40,000. So the total is 140,000 for the EPS equal to 17.21. Then for the bonds payable, if ever the bonds payable will be converted, then the company will be receiving here the 10% convertible bonds payable with face amount of 2 million, and the 9% bonds are convertible into 30,000 ordinary shares. And we have now the bonds payable. The amount of the bonds payable is 2 million. So 2 million and we have now the number of shares to be converted for the bonds payable equal to 30,000 ordinary shares. So we now get the total of 2,550,000 for the diluted earnings per share. And if we have the bonds payable, paying interest at the rate of 9%, total of the bonds payable at 2 million is 180,000. But if we have it at 10%, then it will be 200,000. And we have the income tax rate equal to 30% of 200,000. So that will be 60,000. So giving us the net income after interest or after income tax equal to 140,000. So in other words, the bonds payable here as stated, in addition to 10% convertible bonds payable in the face amount of 2 million. So we have now the 10% bonds payable. So we now get the total number of shares after conversion of the two securities, 170,000, dividing the net income by 170,000. That will give the diluted earnings per share equal to 15. Now, the incremental EPS on the bonds payable is 140,000 divided by 30. So it's 4.67. And the incremental EPS on the preferred stock is 2.60, whereby both are lower than the basic earnings per share. So just like in problem 21-1, both the bonds payable and the preference shares are potentially dilutive because the incremental EPS is lower than the basic earnings per share. Next, we go to 21-3. We have the requirements: compute for the basic earnings per share and diluted earnings per share. Now, given the following information at year end, we have the ordinary shares outstanding 2020, 360,000, 2019, only 300,000. Non-convertible preference outstanding shares in both years, 10,000 shares. And the 10% convertible bonds payable face value in both years is 1 million. The entity provided the following additional information. On September 1, 2020, the entity sold 60,000 additional ordinary shares. So meaning it issued additional 60,000 additional ordinary shares. That's why in 2019, the ordinary shares total was only 300,000. In 2020, it's already 360,000. Because of this additional information, net income for the year ended December 31, 2020 was 6.7 million. During 2020, the entity paid dividends of 30 per share on the non-convertible preference shares. The 10% convertible bonds are convertible into 40 ordinary shares for each 1,000 bond. So if you have now the face value of the bonds of 1 million, dividing it by 1,000, we have 1,000 multiplied by 40. So convertible into 40. So all in all, we'll have 40,000 shares. Unexercised share options to purchase 30,000 ordinary shares at 20 per share were outstanding at the beginning and end of 2020. The fair value of each stock option is 5. The average market price of ordinary share was 30 during 2020. The market price was 40 on December 31, 2020. Warrants to purchase 20,000 ordinary shares at 45 per share were attached to the preference share at the time of issuance. The warrants, which expire on December 31, 2022, were outstanding on December 31, 2020, and the income tax rate is 30%. So first, we compute for net income given is 6.7 million. So for the amount of net income, we divide this, or we first deduct the preference dividend with 10,000 shares, and as stated, the entity paid dividends of 30 per share, or 300,000. So the adjusted income is 6,400,000. On January 1, the beginning balance of the ordinary shares is 300,000. September 1, the company bought 60,000 shares. From September 1 to December 31 is 4 months. So we multiply 60,000 by 4 over 12, or 1/3. So we get 20,000. So we have now the average number of shares for 2020 in a total of 320,000 shares. So the basic EPS is the net income of 6.4 million divided by 320,000 shares, or 20 per share. Then requirement number 2, you compute for diluted earnings per share. So net income as computed above. We now deduct the preference dividend equal to 300,000. That's the preference dividend for a balance of 6,400,000. Then we add the interest on bonds equal to 1 million times 10%. Now the face value of the bonds is 1 million, and we have the interest rate of 10%. So it's equal to 100,000. Then we deduct the income tax rate, the income tax at 30%, giving the net amount of interest equal to 70,000. Now this is interest supposed to be interest expense on the bonds. So the adjusted income of 6,470,000. Here we have your convertible bonds payable. So for the diluted earnings per share, computations. Now, proceeds from assumed exercise of options. Warrants. We are given now the warrants to purchase 20,000 ordinary shares at 45 were attached to the preference share at the time of issuance. The warrants, which will expire on December 31, 2022, were outstanding on December 31, 2020. Unexercised share options to purchase 30,000 ordinary shares at 20 per share were outstanding at the beginning and end of 2020. The fair value of each stock option is 5. So we have now the proceeds from assumed exercise of options. If the company will exercise the options, it will buy the ordinary shares at 20 per share, and the fair value of each stock option is 5. So that will be a total of 25 multiplied by 30,000. That's the proceeds from assumed exercise of options. Okay, so we have now 30,000 times 25. On January 1, the balance of the ordinary shares, 300,000. Then we have the assumed issued ordinary shares through bond conversion of 40,000 shares based on the conversion rate. Then we have the incremental ordinary shares with the option shares equal to 30,000. We now deduct the assumed treasury shares by dividing 750,000 by 30. So we have now the assumed treasury shares equal to 25,000. The warrants to purchase 20,000 ordinary shares which are anti-dilutive because the exercise price is higher than the average market price. So we have now the total of the ordinary shares of 365,000. So it's very important here that we know what is happening, why you have the assumed treasury shares. So for a total of, now that is for the unexercised share options to purchase 30,000 ordinary shares at 20 per share and the option price of 5. So we now deduct the assumed treasury shares of 750,000 divided by 30. So we now get here the result is 25,000. So we have the difference of 5,000. Then we have the warrants to purchase 20,000 ordinary shares which are anti-dilutive because the exercise price is higher than the average market price. So there's no amount. The total ordinary shares, the initial of 300,000. Then we have from the September 1 purchase or issuance of 20,000. Then the assumed ordinary share with ordinary shares through bond conversion, 40,000. And we now get the assumed treasury shares computed at 25,000, and we have the option shares 30,000. So we have now the ordinary shares of 5,000. If you get the total, that gives us 365. Okay, 365,000 total ordinary shares. So the diluted earnings per share is 3 million, diluted earnings per share, 6,470,000. That's the amount of net income as given. Net income for the year ended December 31 was 6 million 700,000. However, after all adjustments and we have now the computation of 6,470,000 for the adjusted income, and we have to divide this by the adjusted number of shares computed above. So we have 1.773 for the diluted earnings per share. Next, we go to 21-4. Again, compute for basic earnings per share and diluted earnings per share. In 21-4, first we have we are given the outstanding shares. The outstanding shares, no? Given is ordinary for both years, and we have the convertible preference. Now, for the determination of the basic earnings per share, first we begin with net income. Given is the amount of 5 million. That's net income for the current year. And from the net income, we deduct the preference dividend at the rate of 10 no the preference shares are convertible into 200,000 ordinary shares, and as well as the convertible bonds into 100,000 ordinary shares. So for the outstanding shares, the convertible preference for 100,000 receiving the annual dividend for 2020 of 5. So that gives 5 times the 100,000 shares is 500,000. So net income to ordinary share for the basic PS is 4.5 million. So the basic PS is 4.5 million divided by 500,000 shares ordinary. Then for number 2, computing for the diluted earnings per share, effect on net income, a preference dividend 50, 500,000 is computed above, and we have the preference dividend 100,000 shares multiplied by 5, so 500,000. Then the interest on bonds payable, the bonds payable is 3 million, the interest thereon is 10 percent, so we have 300,000 multiplied by 70%. Now that is 100% minus the tax of 30%. So we have 70% for the interest on bonds. So the result now is 210,000. Then the incremental EPS for the preference shares, 500,000 divided by 200,000 preference shares. And we now get 2.50. 2.50, while the bonds payable 210,000, that's net of tax, divided by 100,000 in the event that the bonds payable will be converted. It will be converted into 100,000 shares, but preference shares, in the event that this will be converted, they will be converted into 200,000 ordinary shares. So you are already knowledgeable with regards to determination of the incremental EPS. The multiple potential ordinary shares shall be ranked starting with the lowest incremental EPS. Thus, the bonds payable shall be ranked first and the preference share second. The fact that the bonds payable, we have the incremental EPS equal to only 2.10, and on the preference stock it's 2.50. So for determination of the final net income, we begin with basic EPS. Net income is 4.5 million divided by 500,000 shares. So we have now the net income to ordinary of 4.5 million. That's the net income. And ordinary will or we have now your convertible bonds payable for 210,000. That's already net of tax. So we have now the converted shares, assuming that the bonds payable will be converted. They will be converted into 100,000 ordinary shares. Then for diluted earnings per share, we have the amount of 1,000,000 uh, 700, no, net income is 4,500,000 shares, 500,000 convertible bonds payable, net income 210,000. If converted, it will be 100,000 ordinary shares. So the total, we now divide 4,710,000 by 600,000. That will now give us the EPS in the event that there will be no interruptions whatsoever. So we have now the total diluted earnings per share is 7.85 by dividing net income after adding convertible bonds payable net interest. So we now get the 4,710,000 divided by 600,000 shares, or 7.85. Then we have the convertible preferred stock. If the preferred stock will be converted, so you will be avoiding the 500,000 of dividends. So you have to add this back to net income. Shares, now if converted, these preference shares will be converted into 200,000 ordinary shares. So we have 800,000. Now for the earnings per share, initial is the basic, so that's 9 pesos, and then the convertible bonds payable, the computation is now for diluted earnings per share. And we have now the diluted earnings per share. For net income, we divide it by number of shares. That will give us the earnings per share. So the convertible bonds payable, for now we have the diluted earnings per share for 5,210,000 of net income, and the number of shares of 800,000. Now this convertible bonds and the preference share, we really have to emphasize computation of basic earnings per share. Then we go to problem number 5. In problem number 5, we have net in here. Required in problem number 5 are also the basic earnings per share and the diluted earnings per share. Camiguin Company reported the following at year-end: ordinary share capital 110,000 shares, convertible non-cumulative preference share capital, and 10% convertible bonds payable. Share options to purchase 60,000 shares at 15 were outstanding. Market price of share was 25, that's at year end, and average 20 during the year. The entity paid the annual dividend of 5 on the preferred share, and the preference share, these are considered to be preference shares convertible into 40,000 ordinary shares. The 10% bonds are convertible into 30,000 ordinary shares. Net income is 650,000. Then we deduct the preference dividend, that's 5 multiplied by the number of preference shares of 20,000. So we now get the preference dividend of 100,000. Deduct from net income, we have the net income to ordinary share, basic EPS. So net income is computed and leaving 550 to the ordinary shares. Now we compute for the basic EPS for 550,000 net income, then we divide it by uh, 100, or we have 550,000 net income divided by 110,000. 110,000 being the denominator. So we have the basic earnings per share equal to 5. Take note that we have for the ordinary shares, we have a total of 500,000 shares. That's for, no, the number of ordinary shares is 110,000 shares. So that's why our denominator in computing the basic EPS is 110,000 shares. The EPS is 5. Then the effect on net income for the preference dividend equal to 100,000, and the bonds payable, the interest is 240,000. Now for the incremental EPS, the convertible preference share, we have for 100,000, and we know here we have to divide by the effect, no? Or we have the preference dividend of 20,000 times 5, and the interest on bonds at 10% of 2 million, and multiply by the income tax rate of 100% minus 30%. So we have now the 70% portion that should be uh, considered as interest on bonds. So computing now for the incremental EPS, we have to divide the 100,000 nga convertible bonds nga interest. Then we have to divide this by 40,000 shares. We get 2 pesos and 50 centavos. Then the convertible shares, how do we determine the convertible shares? So we have now the The convertible preferred stock, 100,000 as supposed to be dividends, and then we divide by 40,000 shares. The convertible preference shares are convertible into 40,000 ordinary shares. So we get 2 pesos and 50 centavos. Then we have the convertible preferred stock. They end up at 2.50, while the convertible bonds supposed to be, but for our convertible preference share, we have a unit cost, or we have now the convertible price. The incremental EPS is 250 and 4.67. Share options are ranked first, the preference share second, and the bonds payable third. Now, why did we put the rank payable on the front? Uh, okay, so we have now the share options rank first, the preference capital second, and the business payable. Share options rank first, the preference share second, and the bonds payable third. Now for the share options, assume treasury shares 60,000 times 15 or 900,000. You divide it uh, by 20. So that will give the basic EPS 550,000 divided by 110,000. It ends up with 5 pesos. Then share options under shares 15,000 for the share options. So I think we have the company shall report diluted earnings per share of 3.94. The convertible bonds are ignored because the effect of anti-dilutive. Uh, this time, let's Camigan Company shall report diluted earnings per share of 3.94. The convertible bonds are ignored because the effect is anti-dilutive. Note that the diluted earnings per share increased to 4.05. So that gives us diluted earnings per share increased to 4.05. So we have now 4.05 diluted earnings increase to 4.05 and 3.94. That was an early discussion of. Okay, so in 21 dash 6 and 21 dash 6, again we are asked to determine the basic earnings per share and diluted earnings per share. So ordinary shares, January 1, 2020, the ordinary shares outstanding January 1, 2020 has a total par equal to 1 million. So do you have now the ordinary shares on January 1, 2020, that gives 1 million. Then on April 1, the 50,000 shares times 2/5. So we have the amount actually for ordinary shares is 1 million. On April 1, we have the additional shares issued for 50,000. we multiply by 9 over 12 kay September lang. So, 9 over 12. And we have the July 1, another 50,000 times. We have number of months from July 1 to December 31 is 6. So the total now 1,062,500. That's the total. So the basic earnings per share is 5.9 million divided by 1,062,500. Now, but our uh, ordinary share capital for January 1, 2020, we begin with 1 million. Then on April 1, issued 50,000 shares. April to December is 912. So we get 37,500. On July 1, another 6 over 12. So total of 1,062,500 shares. Then the basic earnings computation. Then for number 2, the ordinary shares, January 1, 2020 is here. We have April 1, new branch. We really have to include the maximum. We have July 1, the new branch again of 50,000. December 31, net income in excess of 5 million is 900,000 times 1,000 or 900 times 1,000. So diluted earnings per share is equal to diluted earnings per share is 2.95. Okay, now we go to the multiple choice problems. So anyway, I'll just give you the letter answers to this and share screen. 21-7 with 3 questions. 21-7. There we simply copy from the book. Okay, so we have now 21 next problem. Okay, so we have now problem 21-7. Now please share screen naman na. 21-8. Okay, so 21-8. Okay, 21-8 answer. No, question 1A, number 2 is B as in boy. 21-9. Okay, 21-9. We have the initially in 21-9, compute the number 1 for the average shares outstanding. So the average shares outstanding is to be computed from January 1, 100,000 shares. Then March 1, that's only 10 over 12. And on October 1, we have 8,000 times 3 over 12. Okay, so Okay, so we have in question number 1, the average shares outstanding 82,000 and net income is 5.4 million. We deduct the preference dividend, so the balance is income to subsidiary, which we divide by 82,000 shares. Then question number 2, we have net income, interest on bonds. We have to add back. So adjusted net income is 5,260,000. Then for the share options, 50,000. The treasury shares, 50,000 times 40, 2 million divided by 50, and we have now the average shares outstanding, potential ordinary shares, share options, and bonds. So diluted earnings per share of 44.96. Then 21-10, question 1A, question 2A. 21-11. Now question 1B and question 2B. 21-12, we have A. Okay, then we have 21-13. Question 1 is A and question 2 is D. Maximum amount of earnings per share is equal to the basic earnings per share. On the other hand, the minimum amount is equal to the diluted earnings per share computed as follows. So we have now diluted earnings per share of 117. Okay, so that ends our discussions on chapter 21. Now take note that this is the third discussions that I have finished. So yesterday evening I was able to finish chapters, first chapter 19, then second chapter 20. Then today the completion of my discussions was delayed due to the brownout. So anyway, I'll have this for the last chapter. On Monday, we will be taking up chapter 22, and on Tuesday, chapter 23. Okay, so if you have any questions, now you can ask on Monday during the class. Okay, thank you, and I hope you are following. Convert.